Welcome back, y'all, to another dope edition of Define Your Legacy. I'm your host, Theus Elijah McBee. All right, before we tap into today's episode, just want to shout out our online store of Define Your Legacy, which can be found in the link in the description of this episode. All right, we have t-shirts, hoodies, mugs, all that. All right, so feel free to support the podcast and check out the online store in the link of the description of this episode. All right, before today's guest, all right, we got my man Myles on the show. What's going on, man?
What's going on, man? Thanks for having me.
Absolutely. It's dope for you to be here on the show, man. Definitely appreciate you for pulling up. But if you could, man, just introduce yourself and tell the world what it is that you do.
Absolutely. So first of all, my name is Myles Gaines. I'm from Bridgeport, Connecticut, and I'm sure we'll get into my story more, but I currently work at BlackRock, which is the world's largest asset manager. I'm a salesperson there. So I sell to financial advisors, selling our financial products from mutual funds, ETFs, and some other things as well.
Okay. So off rip, just curious, how'd you get started into that industry?
So it started where I went to college, which is Amherst College. I played football there. And like most of us, I didn't know what I wanted to do, but I noticed that a lot of my teammates were going into finance. And so we have a really big alumni network, and I decided sophomore year, when everybody was in Cancun and everything else, I wasn't on spring break. So I sent about 200 emails probably. And the reason being is because a lot of schools came to campus junior year to recruit for junior internships. And I wanted to get ready for that. So I sent about 200 emails, just asking people what they did and if they wanted to give me 30 minutes of their time. Probably got about 30 responses. And one of my now mentors, one of the biggest mentors I have, he ended up passing my resume to somebody else who worked at a company called Putnam Investments. And that person gave me an opportunity to interview for a role called research associate, which is something completely different than what I do, but still in the finance realm. And I was honest. I said, I don't know what I want to do really. I don't know what company or industry I want to be in, but I do know I want to be a salesperson. And they said, okay, well, let's throw you in the sales pool. And so that was in 2015. I got the internship in 2016. They liked me. I liked them. They asked me to come back full time, and I started full time in 2017. And I was at Putnam until last March in 2021. And the person who left Putnam and I replaced came to BlackRock and ended up being my referral at BlackRock. So that's the quick story as to how I got from college to Putnam to where I am now.
Yeah. And that's dope too, when you mention referrals. But even in the beginning of that story, right, I want to touch on the sacrifice that you made. You mentioned, I think, with spring break, while other people might have been on vacation in Cancun, and you sent out 200 emails. So talk to me about the sacrifice that took.
It was really just me focusing on the future and not, being upset that I wasn't somewhere fancy or out partying or whatnot. But I was in Bridgeport at my mom's house, and I was just trying to make it happen, trying to set myself up for the future. And I figured I have an opportunity. I know companies are coming to campus. Why waste my time and just kind of do nothing? I could be proactive and try to set myself up to lock in one of these jobs that could really change the trajectory of my future. And so I kind of saw that at a young age. I was fortunate to have good parents that instilled hard work in me. And I was motivated by friends and former teammates who were going on to do some pretty cool things. And like I said, I was motivated. So I sent out those emails, just being hopeful, trying to lock in something for the future and set myself up for success.
And you talk about being motivated, but I also want to know when you're motivated. And so it's easy to be motivated before you send those 200 emails, right? But let's say you send all 200 at the same time. And I think you said you got back like 30, right? So were you ever nervous that not everyone emailed you back, right? Like, were you ever nervous that like, okay, I'm sending out a bunch, but damn, like, what I'm saying, I'm not getting a response rate. Was that something that you thought about?
It was something I thought about. And I think it started with me playing football and the recruiting process, honestly. So to me, it was kind of the same thing because I was a smaller football player. I was good, but I was smaller on the field, and I knew I had a disadvantage. And so I was reaching out to a bunch of coaches in high school trying to get recruited for college. And so to me, it was really the same process. It was trying to prove myself, sending my transcripts, sending my highlight tape, going to football camps, getting rejections, getting interest, and getting dropped. I had already kind of been through that before. So I kind of put myself in that mode and thought, it's a numbers game. right? And it only takes one. It only took one coach to recruit me to go to college. It only took one person to accept me and for me to accept an offer letter to get into a career. And so if I can tell anybody anything, it's play the number game. Don't get discouraged. Send out those emails, do those interviews. It really only takes one. But that was really where that preparation came from, the recruitment process in high school.
Yeah, and I'm definitely with you on that. I'm a big fan of volume over efficiency.
Yeah,
Like it's
definitely.
not like, what I'm saying, you got to get them out. Like you said, all it takes is one yes, right? All it takes for one person to really take a chance on you. But I think, and the reason why I asked that question about motivation, because I think early on, people might send out 5 emails, whatever the case may be, start something and stop after like 2 weeks. But like, you just got to get your reps up, right? But talk to me too about the transition, right, from going from college to now entering a new type of competition, if you will.
Yeah, it was a big transition for me. So first of all, it was my first time moving away from home outside of going to college and coming back on break. So I'm in Boston. I moved to Boston at the time. And one thing that is interesting when you get into some of these industries, everybody knows everybody. It's your parent or your parents' roommate from college or your uncle or some connection that they have from Princeton getting them into the job. And so there's a lot of people who were having conversations about finance and mutual funds and financial planning at the dinner table as kids.
Mm.
And these are things that they heard throughout their entire lives. And this is just the next step for them. I was a first generation college grad in my family. My mom was the youngest of 10. I was, I'm her oldest child. I'm the first on that side of the family to graduate from college. Really the first person to get into financial services or anything like it. And so it was all new to me. And so on the first day, I was selling mutual funds. And on the first day, the first bullet point on the first page of the book is what is a mutual fund? For a lot of people, that's review. For me, that was the first time I saw it outside of the interview. And so the transition was just putting in the extra hours, doing more research on the weekends, really trying to network with people as much as possible to hear their stories, trying to find mentors, people who had done it before me, either at the company or outside, so I could pick up on little tidbits, just so I could really play catch up to the other people that I was with that were entry level, because for them, it wasn't entry level knowledge. They had already seen it and heard it before.
Yeah.
And so that was a transition. And it just came into putting the extra hours, but then also I was interested in it. And so it was easy for me to put in the extra work because I quickly found that it's something that I really enjoy. I like learning about things that can help me in other avenues. Like, for example, who doesn't want to know about financial literacy? That's my job every day.
Mm-hmm.
And so I was learning things that I was able to tell my family about, tell my friends about. And so I was willing to put in the extra work because it was tangible things that I knew could help me and others. So that was the transition. And I'm still working harder than the person next to me, or at least trying to, because I have goals. So it's really working hard, but it's also working at something that you're interested in. Otherwise, it's going to be hard to put in those extra hours.
Yeah. And a part of that too, because I got a couple more questions about mutual funds and ETFs and words like that.
Yeah.
Was a part of that story. I think you mentioned you were the first, right?
Mm-hmm.
Like the first one, I think, in your family to really get a job in the finance industry, and the first one, I think you said, to graduate from college.
Mm-hmm.
And
On my
so
mom's side, yeah.
on your mom's side. And so talk to me too about if there was any possible pressure that you might have felt, whether it be through, internal pressure, just overall. Did you ever feel like, all right, I have to do this, right? Like, all right, man, I have to be the one.
Yeah. Luckily, my family didn't pressure me so much, but my parents sacrificed a lot. They sent me to private school, took me to a bunch of different football camps, sent me to Amherst College. And I mean, I'm sure there was an expectation for me to succeed. In no way was it pressure, but if somebody puts you in the right position to do something, personally, I didn't want to mess it up. And I don't want to mess it up. That's still in me. There was no real pressure from anybody else, but it was just pressure for me to succeed. Number one, I'm a competitive person. Number two, I want to make sure everybody's sacrifice was worth it. And number three, I have a lot of supporters, both family and friends. And so I don't know if it's pressure, but number one, I personally want to succeed. And number two, I want to make sure everybody, my supporters are proud of me. And I want to help others as well. And the only way I can help is to keep learning, keep growing, and then sharing the knowledge.
Yeah. And when I say pressure, I mean, like, did you personally ever put pressure on yourself?
Oh,
Right.
yeah.
The thought of like, okay, I have to do this
Yeah.
so that everything that they sacrificed for me was worth it.
100%. Yeah. If that's the question, then yes, without a doubt.
Mm.
Yeah. And I still feel that.
Mm.
But, it's also, you have to pace yourself as well, is what I realized. Like if you burn out, then you burn out. I'd rather work hard, but still be able to rest, still do some things that I enjoy after work on the weekends, etc. It's working hard, but it's also pacing yourself for the long term, which is something that I have to learn. Because sometimes I'll go crazy for 2 weeks. Now I'm tired, haven't worked out, haven't talked to anybody, friends or family, and then you got to kind of step back and regroup. And it's about balance at the end of the day.
And that work-life balance is real, especially I think with a lot of people in our generation, our era. Everyone wants to, kind of go and go and go, but eventually you don't want to hit a wall where it's like now you really feel burned out because that's just not good for anyone.
Sure.
But I mean, you mentioned mutual funds and ETFs a little bit. What would you say to someone who might be confused by a bunch of like stock market terms? Like, well, what's a mutual fund? What's an ETF? Like all these different things like are confusing to me. And you don't have to break each of them down like one by one, but it's the idea of like, to some people, they may want to get into the stock market or just overall learn more about it, but the words might throw them off. So what would you say to someone like that?
I would say a mutual fund or an ETF is a basket of individual stocks or bonds. So you can go out into the stock market and buy one share of Tesla or Nike or Apple, or you can buy a mutual fund or ETF that has all of those companies and more in them. And so, for example, I'll just explain what the ETF is. An ETF is exchange traded fund. An ETF tracks an index like the S&P 500. When people say the stock market, usually they're talking about the S&P 500. Well, an exchange traded fund is just a basket of stocks that mirror the S&P 500. So it has all those 500 companies in it, and you can buy it as opposed to just buying one share of one company. Now, what's the benefits of that? Well, number one, it's professionally managed. So there's a portfolio manager who's watching it every day. But then number two, it's a diversification piece. If one company completely tanks and you only have stock in that company, then you just lost all your money. But if one company in an ETF tanks, well, you might lose a small percentage, but because there's other companies in it, you only lose a little bit of money, or you can still gain money if another company rises more than that company falls. And so for people who don't have the time to research individual companies and really find out which individual company they want to invest in, it's a great way to invest in the stock market, have it be professionally managed, and have some diversification so it can protect you more when things go wrong. Kind of like right now, if you've seen the stock market over the last 5 weeks, there's been a lot of red. And so that's what an ETF is. And then a mutual fund it doesn't track an individual index. A mutual fund has somebody who invests in essentially almost anything they want, and they're trying to beat the market. So an ETF is a basket of stocks that tracks the market. A mutual fund is a basket of stocks. Its goal is to try to beat the market, but they charge you a little more because they're trying to get higher returns. And so, again, I mean, if you want to talk about it more, we can break it down a little further.
By all means. By all means. By all means. But one thing though I will say to address too is when we talk about ETFs, why is that diversification so important? And I mean, you talked about individual stocks versus an ETF. So even breaking that down a little bit more, like what exactly does that mean?
Right. So let's take Microsoft, for example. If one person had $1,000 and invested only in Microsoft, and one person had $1,000 and invested it in IVV, which is the iShares S&P 500 ETF. So IVV is the ticker. So for anybody out there listening, if you want to look it up, just type in IVV into Google, and you'll see what the ETF is. So if we both had $1,000, me and you invested into all of Microsoft. Essentially, your returns are only going to be based on what Microsoft does, right? So you're riding with Microsoft. If their company does well, your money goes up. If their company does poorly, your money goes down, guaranteed, because that's the only company you're invested in. If you invest in IVV, Microsoft is just one of 500 companies that you're investing in. You have a little bit in Microsoft, you have a little bit in Apple, you have a little bit in Tesla, you have a little bit in 497 other companies. And so the reason why diversification is important is I talked about it a little bit earlier. It's you're able to get access to more than one company, number one. And especially when you can't buy fractional shares, like if you look at Google, it's $3,000 to get one share of Google. That's hard to do. Everybody doesn't have $3,000, so you can buy an ETF that invests a little bit in Google, still have access to what Google is doing. But if Google does poorly, if Microsoft does poorly, if any of those individual companies do poorly, you still are being diversified. So you have an opportunity to still make money or not lose as much money because you're invested in other companies that are doing something completely different. So I think diversification is important because it gives you access to a lot of different companies and it helps protect your money.
And honestly, you know what? Protecting your capital is very, very important too. I know people only like to look at just the, trying to make money part, but you want to make sure that you protect the money. Because especially too, if you have a job and you work so hard for it, like make money, don't get me wrong, try to beat inflation and all that, but like protect it because you know what I'm saying, stocks also go down. And I think that's the part that especially our generation needs to realize. But let me ask you this, right? Let me play devil's advocate, of course. What would you say to someone who, let's say, is our age, and they say ETFs are too slow, right? They don't. I can't make 50% in a day. I don't have a chance of doubling my money within 2 days. What would you say to something like that?
I would say you're right. They are slow, but I would say if you play the long game and you play the percentages, then you're going to make money over time. We at BlackRock, we have a chart that shows you the percentage of time you make money over 5 years, then over 10 years, then over 15 years, over 20. And over 20 years, 100% of the time, if you invest in the stock market, you make money. Now, again, that's 20 years. If over 5 years, over different time periods, you're not guaranteed to make money, but over 20 years, you are. And so if you want, I want to say guaranteed because nothing's guaranteed in the stock market, but based on history, what we've seen is if you're playing in the stock market, right, ETFs, et cetera, the longer you invest, the higher chance you have of having positive returns. And hopefully over time, you're continuing to invest, your dollar cost averaging, and you're buying up more shares. And so is it slow? Yes. But one thing history has taught us is that it's a very, very almost positive and almost guaranteed way to make money. And sure, there are other things that have made more money quicker. But number one is, do you have time to research it? Is it like, do you have a day job or are you busy? Do you have time to find that moneymaker? And number two, my question is, how much risk is in it? And I'm not saying ETFs and mutual funds and stocks are the only way to go. But all I'm saying is know your risk tolerance. Person A might be willing to take the risk and put it in a quick flip. But person B might want to play the long game and go with the percentages, go with history. And if you're like person B, then I think ETFs and stocks are the way to go.
Yeah. Especially if you want to be like a lazy investor.
Right.
Like it's I'm not a person that feels like you should live and die by ETFs. I am well aware especially like I said, with our call it what it is, with our culture, right? People want to get rich quickly. And I don't think that there's anything wrong with that at all. But one thing I will say though, is sometimes most people, ironically enough, can't even beat the S&P. Right. So that that's another conversation that so because if you make just mathematically, you don't gotta be a genius. But if you're up, let's say 20%, let's say you got two investments, and you're up 20% on one of them, you say, all right, cool, I'm making money off this, I'm being SP. But you're down 80% in another one.
Right.
Like
you're down 60%.
You know what I'm saying? Yeah, your portfolio is everything. Right. And again, like I said, I'm sure you know too, like there are people that can beat the S&P, but there's a lot of research that goes into it. But as to, young individuals, what would you say too is the importance of time and really starting as soon as possible?
Well, one of the main things we say is time in the market, not timing the market. And the reason why we say that is because I talked about a little bit earlier, fractional shares and the importance of compound interest. The quicker you start, the more you're able to accumulate more shares. And the more shares you have, the quicker it grows, the larger it grows, better chance you have of having a lot of money later on. And so I don't have the exact numbers, but I'm sure we've all seen the quotes where somebody starts at age 25, they just invest in the S&P month after month. They have over $1 million by 65. Meanwhile, the same person who starts at age 35 has a lot less by age 65. Again, everybody says in every interview, you can look it up, but I don't have the exact numbers. But it's time in the market at the end of the day. It's compound interest, it's buying now and buying regularly, treating it like a bill and buying on a normal cadence, whether that's monthly, quarterly, annually, whatever it is. But the more you're able to buy up, the more that's able to accumulate, then you can buy more shares for yourself, the better chance you have of having a large lump sum of money. And like you said, it's really for the lazy investor, not only for the lazy investor, but if you're a lazy investor, it's the way to go. Because again, like I said, history tells us, percentages tell us, if you just buy the S&P or buy some of these large indices, NASDAQ, Dow Jones, etc., there's a very good chance that you're going to have a large lump sum of money later on.
Yeah. And talking to you said treat investing like a bill. Break that down a little bit more for me, if you don't mind.
Absolutely. So the way I see it is, in the way we tell advisors and the way they tell their clients is dollar cost average. And all that means is get on a normal cadence, whether that's bi-weekly, like you're getting paid, whether that's monthly, quarterly, annually, etc. But treat it like a bill, just like you pay your rent every month, just like you pay your light bill, gas bill, etc. Treat investing like a bill, right? You already do it in your 401k if you have one, right? They take money out every pay period. So why not do it even more if you're on your own, if you open up a brokerage account or if you're opening up a Roth? But buy up more shares, because if you just buy one time, whatever that amount is, you're not going to have as much as you could if you just throw in $50 or $100 every month. And so find whatever your budget is, whatever you're comfortable with, I can't tell you what that is, but treat it like a bill and budget to be able to invest so you can buy up more shares over time.
Yeah. And what I would say too off that, like for people that may have a difficult time figuring out what their number is, just think of it like, what would you spend your money on anyway? Right? Like, what would you spend your money on things that may not provide value? And again, I'm a big advocate of like, you can always do both, right? Spend your money on investing as well as, going out, enjoying yourself. But like, just think of it as like, what would like money that you wouldn't care to lose, right? Like I'd be upset if I lost $20. Don't get me wrong. Like money is money. You feel me?
For sure.
But like whatever it is that like, like, you feel me? Like money is still money, but like it wouldn't like hurt me. It wouldn't be the end of the world. Like life would go on. So whatever, like, you increase the number to whatever it is, you feel me? And it adds up over time, right? It adds up over time. But you mentioned fractional shares too. So what's the mindset and approach towards that?
Well, it depends on where you open your account, because so if you have a brokerage account with TD Ameritrade, Schwab, right? You name it, you pick a brokerage account. Some allow you to buy fractional shares and some don't. So for those who don't have an account yet, I would research which brokerage accounts allow you to buy fractional shares, because say a stock or an ETF or a mutual fund costs $500. If you don't have 500 on the dot and then a little bit more for that trading cost, you're not going to be able to buy it until you have that amount of money. But if you have an account, Robinhood, etc., where you can buy fractional shares, then whether you have $10 or $500, you can buy in right now and watch it grow. And so if you balling like that, you got it, don't worry about it. But if you're somebody who wants to budget, maybe doesn't want to put in that much money on a monthly basis, find an account that allows you to buy fractional shares so you can at least do something, because something is better than nothing.
Right. Right. And, I know everyone listening to this is going to say like, I got money. I don't care about it. Okay, cool.
Yeah, you got it.
Right. You got it. All right. So I want to say though, too, is like one, fractional shares allows everyone to play the game, right? Everybody.
Exactly.
You mentioned $10, right? That's less than a damn t-shirt, right? So literally everyone, in my opinion, I'm not in anyone's pocket, but if you got enough money to buy a damn box of pizza, you can, invest in stock market. And so I would also say too, it allows you to invest in pretty much, for the most part, anything within the market, right? So common companies that might be a little expensive or, in some people's eyes is like, you use Google, but they're, with the stock split and stuff, but Amazon, right?
Yeah.
That one roughly,
Yeah.
I think around this time, this records like 3K a share or something like that. An idea, the average investor or like the beginner investor, I'll say,
Mm-hmm.
isn't really willing to rack up three racks, just especially in the beginning, like as you
All
know,
for one company too.
yeah, off of one company, not like, all right, let's slide this to 10 different ways off one. And so fractional shares, I'll preach this until I'm blue in the face for all the beginners out there.
Yeah.
They allow you to get started with a deep or smaller sample, right? Like a small amount of capital.
Mm-hmm.
So there's no longer like an excuse, right?
Right.
It's not like,
There's
all
no
right,
more barriers.
stock market is one of those areas where it has a low barrier of entry.
Yeah.
Like just simple, like, okay, I have $20. Can I still play the game? Yes, you can.
Yes. Yeah.
Like I don't know too many people that done bought a house for $20. Like
Right.
it's tough to start a business for $20. It's tough to do anything really with $20 with just that. But like
Yeah.
investing in the stock market, it really makes it a lot simple. So do you ever like I guess going off that have like either a mindset or just thought towards stock specifically, not necessarily like charting or anything like that, but obviously the next question is, well, what do you invest in? Definitely not ask you that. We're gonna
Yeah. Yeah.
say none of the things that we say is financial advice for the record, but just the idea like, are there certain things that you look for? Are there certain articles or websites that you might read or stay on top on?
Well, one thing that we talk about, and this is how we coach up financial advisors to talk to either clients or prospects, is the everyday test. And so I'm just looking at the S&P right now, and I'm just going to kind of walk through the top holdings.
Please
And
do.
so top holdings in the S&P are Apple, Microsoft, Amazon, and Alphabet, which is Google's parent company. And so if you wanted to start looking at maybe individual companies to look at, just walk through the everyday test of products that you use already. And so you woke up with an alarm on your Apple phone. Then you got up and you sent a couple emails with Microsoft Outlook. And then you ordered something off of Amazon. And then you Googled a new term for work. And so I just walked through the top holdings in the S&P 500, and I use the everyday test. And those are things that we do every single day. And so think about what you wear, Nike. Think about what's in your fridge, probably a General Electric fridge, right? Think about the car you drive. If you got a Tesla, that's what's up. But maybe it's a Ford or something like that. When you go to run errands, where do you go? Maybe it's Home Depot. Those are all publicly traded companies. And so we tell people, if you want to start looking at individual, this is twofold. Number one, it's if you want to look at individual companies, use the everyday test. What are you using on a daily basis? I'm pretty sure a lot of those companies are publicly traded companies. And then on the other hand, the way I sell is, hey, I'm presenting Mr. and Mrs. Advisor. I'm presenting this mutual fund. I'm presenting this ETF. Your clients should be comfortable investing it because they're already using these companies already. So number one, if people want to start kind of looking at things individually, use the everyday test, but that's also how I sell too. And then as far as what I'm reading, Wall Street Journal, I feel like you have to look at the Wall Street Journal. I have a morning newsletter that I get called Morning Brew. It's an email that I get. It's a quick email. It's about a 2-minute read. So those are a couple quick things that you can learn a lot just with those two.
Yeah. And I appreciate definitely the beginning part too, is like just making investing as simple as possible.
Yeah.
But like, don't try and overthink it.
Yeah.
And I like that everyday test, right? Like, what is it that you already use? Work backwards, right? Work backwards.
Yeah.
Like, don't make it any more complicated than it has to be.
And then you're a beneficiary of the companies that you're paying anyway. So, I mean, if you got the newest Apple phone, if you got all the newest Jordans, you might as well pay yourself. You're already paying the company. You might as well be a beneficiary of their stock rising. So definitely start with the everyday test. I think that's the easiest way. And then if you want to get into nitty gritty and see, who their clients are, where they're getting some of their pieces from, things like that. It's a really easy way to segue into the nuances, into like the deep parts of the stock market.
Yeah. And I think what makes it so cool is that, like, when you're asked to study like in high school and stuff, like there's certain things that's like, okay, am I really about to use this years from now?
Yeah,
what I'm saying? Like,
the answer is probably no.
Yeah, you know what I'm saying? But like this is, what I'm saying? Like, this should be normalized in terms of like, yo, this company's doing this. And most people are like, what? Why do you even know that? But at least
Right.
it's because like you're plotting for your own money. There's a reason to know this stuff.
Yeah.
So it's just, I think, imperative for people to really kind of do at least a little bit of research. But even if not, think about what it is that you already use. So what are your thoughts? Do you care at all towards dividends? Most people have like mixed feelings about them. Obviously it's for the most part free money in a way, but most people feel like they're overrated. So do you personally have any opinions on them? Generally speaking.
Yeah, I think it's more relevant for the people who quote unquote need or want income. Right? It's a great way to get residual income. So if you're older and you're trying to live off that income, you can take the dividends out and use that for your everyday life. Obviously, our demographic, we're not in that situation. So I reinvest all my dividends.
There we go.
But I think it's a good sign when a company's paying one out because it means they have good cash flow. And it means that they're trying to pay their investors to stay, and they're rewarding you for investing in their company. And it's a quicker way to get more shares. Because if you're getting the dividends and you're reinvesting, it's going right back in the stock market, your value is going up. Eventually, you're going to be able to buy more shares. And so I like dividend paying companies, whether it's later in life, I'll be living off the income. But for now, I'm just able to reinvest and buy up more shares over time. And it's paid, like you said, it's essentially free money.
Yeah. And there's nothing wrong with that. Like dividend, like we both said, it's free money. It's not like you don't have to do anything for it, right? It's not like, you got to do certain things. So, but I would say too, so what do you mean by reinvesting dividends? I mean, I know, but just make sure everyone, it's clear on that.
So you have two options. If a company pays out a dividend, whether it's monthly or quarterly, annually, you can either take out the dividend and take it in cash, or you can choose to reinvest. And that just means put it right back in the stock market and add more to the company that you own. And so if your stock is worth $1, the dividend is 5 cents, you can either choose to take that 5 cents, or you can reinvest that 5 cents. And now you're $1.05 is growing in the stock market as opposed to just that dollar. And so that's essentially what it is.
Yeah. And I know that after a while, when people see like the dividends and like the ratios and stuff like that, they might think, well, this isn't that much. Well, like, what I would say in response to that is it's probably higher than the bank. It's probably higher than your savings account. So it might not be 30%, but it's probably higher than what the bank is offering you. So
take a look at your savings account. It's 0.00001.
And then when you combine that with beating inflation,
right?
Like they're printing money left and right. And so now I feel like we're just in a position where you don't have a choice but to invest. Right.
Yeah. Well, CPI, which is an inflation kind of category, it's at 7% right now. And that's insane. And so just to put that in perspective for people, if you got a 3% raise last year and inflation is at 7%, it's still worth negative 4% than what you got. Like, so your raise didn't even beat inflation. And so it's important to invest. And we have charts that we share with investors and clients all the time that show if you're leaving your money in the bank and inflation is above zero, you're essentially losing money. Your money is not worth what it was because inflation is above zero. And so you have to invest to beat inflation, because 5-10 years from now, inflation is not going any lower. It's not going anywhere. And so, like you said, you have to invest. It's a smart thing to do. And again, if you need an emergency fund, so your savings account shouldn't be at zero. It should not be at zero. But once you're at a point where you're comfortable and you're able to take care of your bills and you have that strong emergency fund, throw it in the market. Find a way to invest.
Yeah, because there's also too, it's possible to like overinvest if you know what I'm saying. Like to your point, you even with inflation and the savings account interest rate and all that, it's important to have some sort of emergency fund. Don't get me wrong, but like how do you feel, or how would you respond to someone who says in their mind they have all their money 100% in cash, like, and they might think that that's a good thing. Right. Like I got all this money. I've had the same amount of money for years.
Right.
What would you think about that? Not necessarily what you say, but what do you think about that?
I think you're losing out on returns. I think most financial advisors will tell you you should have 3 to 6 months of net income saved in the bank. And if I think if you have that much, then you can, you get a flat tire, your car breaks down, you get laid off, whatever the case may be, that's probably a good nest egg to figure things out, to help you out while you figure things out. After that, you're losing out on returns.
Yeah.
What is it doing in your bank account? Like, why? You know what I'm saying? When we already said the stock market is going to return at least 10% a year. For the last few years, it's been more than that. But you're missing out on returns. You're missing out on dividends. You're missing out on compound interest. You're not doing anything wrong. You're just not doing what you could be doing and making the amount of money that you could be making. And so again, it's about being at a point where you're comfortable, and that amount in your savings account, that's going to be different for everybody. You can't tell anybody what to do. But after that is look at what you could be making. You're missing out on opportunities.
Yeah. Yeah. And I think some of that I feel comes with like trust or lack of trust. It's like people not knowing and people being afraid of like, oh, I don't want to invest my money. And so what I would say that too, now that I think of it in my head, to the people that say like, oh, I might lose, my money if I invest. Well, I can assure you and guarantee you that you're definitely losing your money. You can get innocent, like, and it's just real. Like that's really my opinion. That's not even just like, all right, I think you with inflation and how it works. If you've had the same number in a bank account for years, right? Numerically, it might be the same. You didn't lose anything, right? But you lost something. Like the value of it just isn't the same. And so we're put in a position now where you don't really have a choice but to invest. But I got to ask too, right? Like during your journey in finance and investing, everything like that, have you seen a lot of Black people in the space? Have you seen a lot of African Americans in that industry?
No, I haven't. And many times, it's funny, I cover Atlanta and I just started covering Georgia and Alabama this year. And I've talked to more Black financial advisors, and I can still count them on two hands in the last 5 weeks than I have in my entire career. And I started in 2017. And so that just goes to show the answer is no. There's not many of us. And I think one of the reasons is it's not advertised. Like this is an advertised industry. It's very quiet. There's a lot of money that's circulated and it's really kept closely. If you remember me saying, I worked with a lot of people whose relatives and cousins and uncles also worked in the company. And I think that's on purpose. And so the biggest thing is access. So we need to do our research, need to network, use LinkedIn, use Google, reach out to people, reach out to me if you're out there, because there's not that many of us, and we can do it. If I can do it, a lot of people can, that's for sure. But no, there's definitely not a lot of us. Many times I'm the only Black person in the room, and it's not a surprise anymore. It's kind of what it is. But I definitely want to get more people in the room because it's a great industry, and we definitely do it.
Yeah. And I mean, representation definitely does matter. And obviously you and I are both, mature enough and have reached an age where it's like, okay, you kind of know what you're walking into ahead of time.
It is what it is, right?
Yeah, it is. Right. It is what it is. You just got to, deal with it. But to like the young people out there that might feel like, well, damn, I'm walking to a college where I don't really see too many people, or, I'm in an environment where everyone that I know is quote unquote making money doesn't look like me. It sucks, but you may have to be the one that changes everything.
Yeah.
You may have to be the one that just starts, a new trajectory for, your family and your life and everything like that. It is what it is. But one thing I'll say too, and you let me know your thoughts on this. You mentioned LinkedIn and Google. How important is information to you in the grand scheme of all this, right? The fact that information is now at our fingertips, literally with our phone. Information is now available on podcasts and videos and things like that. So how important is that? To know that people can really like learn this stuff if they really want to.
It changes the game. I mean, I think about 20, 30 years ago, how much harder it was to get information, like having to go to the library, etc. But now, like you said, with podcasts like yours, I mean, you're changing the game, right? And there's so many podcasts out there talking about stock market, about real estate, about fashion, about music, anything you can think of. There's a podcast, there's a book, there's an article out there. And the beauty of it is when you hear these companies, when you hear the name, you can now go on LinkedIn and message anybody for free. And so there's really no excuse. Once you kind of get just an idea of what you want to do, I would say reach out to people immediately, find mentors, ask people for 30 minutes of their time. If they're near you, ask them to get a cup of coffee. If they're not, ask them for a phone call, and listen to as much as you can, read as much as you can. It's very important. It's how I got my job, just talking to people and finding mentors and people trusting me and betting on me. And I definitely look to mentor people who are younger than me. Whenever somebody reaches out, I say yes. I give them my time because, I mean, that's the name of the game. That's how we change the narrative.
Yeah, please, yeah, please. Even if you have to do it alone,
Yeah,
right. Like even if you have to do it by yourself, it may not be a fun ride, but it's necessary and it's worth it. Like,
worth it.
I know sometimes it's more fun and better to do it with your friends or your family. But if no one else, if you're listening, if no one else out there either thinks like you or wants to kind of change their situation, hey, it is what it is. But you don't have to be a product of your environment. You don't have to be, stuck in a certain situation. We live in an era now where information really, really is everywhere. Like it is, and it's free. Like, and it's free. It is.
Yeah,
Like, to the people that say, like, I never went to school. Well, school was expensive, and that's a reason why a lot of our people don't go to school, right? Especially when we talk about student loans,
yeah,
right? But like this YouTube stuff, this podcast, this social media stuff, it is free, right? The barrier of entry is not as crazy as you might think it is. All right, just watch a couple of videos, and your situation may change.
yeah. And you don't need a degree to invest in the stock market.
You don't. You don't. There are jobs you might, need to get active with the resume. Certain things you might need, your master's and, go to school for like 10, 12, 20 years, whatever. But some of this stuff, it just takes you literally logging on to youtube.com and just sitting down.
Yeah. And I always tell people to make a brokerage account where you either make a normal brokerage account or a Roth IRA or whatever it is. It's really funny how quickly you can make that account. You can make that account just as quickly as you make an Instagram. It's that easy.
Damn.
And so look it up. It's not hard to do. You can do it on your computer or your phone right now. And so if you haven't started, please start.
Yes. And that is an important word. Start. Like, please, whatever you do, don't compare yourself to anyone.
No.
Especially on social media. That will ruin a lot of people's minds. Like, people very, very rarely show off their failures on social media. You are not about to see someone post a negative bank account on the social media. You just will not. That won't happen. Okay, so don't let social media fool you. Like, start as soon as you can. Even to your point, you mentioned fractional shares. Even if it's just like with like $10 or $20, because from my experience in the beginning, right, it was more about overcoming the fear of putting money in the market. Right now, as you get older, it's like, all right, I got to throw in, X amount. I'm not gonna say no, but X amount. It's like, all right, it is what it is. This part of the game. And so starting will probably end up being your best decision that you'll make. So just please, y'all, just start. But obviously, you talked to me about your journey and everything like that to where you started to where you're at now, even going back to sending out those emails, deciding going to Cancun and enjoying your spring.
I didn't go against it. I ain't had the money.
Well, either way, that's going against it, whether it was your choice or not. Whether it was your choice or not, what I'm saying? You still decided to play this. You made the most of your time. You know what I'm saying? Like you didn't just say, all right, I can't go and I'm just going to chill at the crib. Like you decided to really take that next step and even, move forward through college and where you're at now. And obviously, I'm sure your family is proud of you. But the question that I want to ask, and it's the last question, and a question I ask everyone that's been on the show, Define Legacy, is how do you want to be remembered?
I want to be remembered as somebody who worked as hard as they could, who maximized their potential, and who shared the wealth, not only monetarily, but knowledge-wise as well. There's a lot of things I've learned that have served me well, that I can help others. And I've shared a lot of knowledge with a lot of people, but the more I learn, the older I get, the more free time I have. I want to share my knowledge on a larger platform, on a larger scale. And so whether it's in finance, I also want to get into football coaching, mentorship. I just want to be somebody who's known as somebody who worked hard, was successful, who did their thing, and then spread the wealth with any and everybody.
Yeah, yeah. And it's important to kind of give back and just be a good person of value.
Definitely.
Life is obviously, we had this conversation about the stock market and investing, but life is also precious enough where, I think it's important to kind of give back and,
Yeah.
finding your role and where it is that you fit in society in the grand scheme of things. So, but definitely thank you again, man, for being on the show.
Thank
You
you.
have I guess, you want to drop your social media or your email or where people can find you, your LinkedIn, or if you haven't, whatever it is that you want in terms of, letting the world continue again to know who you are and where people can find you.
Definitely. So MG, my initials MG underscore live free on Twitter and Instagram. My name, Myles Gaines, what you see here, MYLESGAINES. You can find me on LinkedIn. If you want to talk about whatever it is, finance, you name it, let's talk. Also get into the fashion game a little bit. So if you want to talk about that, let me know. Simple Fit
Facts,
CEO on the
facts,
way.
facts, facts. Simple Fit
Yes,
CEO.
sir.
We see you.
Yes, sir. But yeah, could reach out to me. Happy to connect. Happy to talk.
Appreciate it, man. And are there any final words that you want to leave our lovely audience with?
Start now if you haven't already. If you have started investing, keep going and spread the knowledge with people, especially in our community. It's amazing how many people don't know. And I think the more we share, the better off we'll all be.
Facts, facts, facts. We all can win, right? I think that's very, very important. We all can win. It doesn't have to just be a solo thing. We all can win. The stock market is a place for everybody. It's not just, all right, only one person can invest. No, we all can. Okay. But yeah, so on the Define Legacy front, y'all, again, make sure you follow Define Your Legacy, all right, on Instagram, Twitter, Facebook, literally type in Define Legacy, subscribe on YouTube, Apple Podcasts, Spotify, wherever you get your podcasts. Again, make sure you check out the link in the description of this episode for Define Legacy's online store. Myself at Theus Elijah on Instagram and on Twitter. And just like that, y'all, we gone. Stay blessed. Peace.